Hello and welcome to Options in Plain English Advanced Edition. Today we're going to be talking about Greeks, and in particular we're going to be looking at how the most relevant Greeks to option traders, delta, gamma, vega, and theta, react to changes in underlying price, implied volatility, and time to expiration. We're going to be reviewing this information visually, as it is sometimes hard to get a feel for how those Greeks change as conditions change. This will give us an opportunity to briefly discuss higher order Greeks. Even if you never have to use higher order Greeks, it is important as an options trader to understand how they impact the behavior of the Greeks that we do monitor and pay attention to, which are all the first order Greeks plus gamma. We will also look at quick formulas for the Greeks we use the most, along with approximations that will allow us to easily calculate the Greeks for your position, using the At-The-Money Straddle and the distribution of those Greeks. We're going to start by talking about option Greeks. What are option Greeks? Option Greeks are risk sensitivities or risk measure. So in other words, if I have a position made up of options or options themselves, standalone positions, or anything related to options, I need to know where my position is exposed, where am I going to make money, and where am I exposed to a risk that is going to make me lose money. In particular, we're going to be looking at these Greeks, and of course, not all of these are as important as the others, but we're going to see what they measure and what they represent. On the left-hand side, we have option price, delta, gamma, vega, and theta. These are the most important Greeks for us because they measure the things that we're going to look at now, and those are the ones we're going to focus on. In this lesson, what we're going to do is I'm going to take these Greeks and I'm going to see how they change as we change the underlying price, the implied volatility, and the time to expiration. So let's review those Greeks now. The option price is the premium. This is the amount that you can buy or sell that option at. Remember, it could be a call, it could be a put. The Greeks have signs as well, so they have an actual value and a sign to them. The delta measures how the option price changes as the underlying price changes. So it's basically if the underlying price goes up by $1, how much is that going to be reflected in my option price? Vega measures how much the option price is going to change as implied volatility changes. And the measuring unit here is going to be a 1% in implied volatility. So if I have an implied volatility that's a 20 and it goes to 21, how much of that is going to be reflected in the option price? So as we know, options are more valuable when there's more implied volatility because they have a higher probability of making money. So this particular Greek, Vega, which is actually not a Greek letter, but is represented with this sign, with this symbol, measures how much your option price is going to change, whether it's a call or a put, as implied volatility changes. Theta measures how much the option price is going to change as time to expiration changes. When you're holding a call or a put, an option in general, that option is a wasting asset. So theta measures how much that price is going to change. So if you are long an option, it's going to be a negative number because it's going to be decreasing as time to expiration starts to pass and time to expiration starts to decrease as we approach actual expiration. Now, if we take these three main Greeks or first order Greeks, we're going to see how they change in the same parameters. So if we look at delta, we know that delta measures how much the option price changes with the underlying price, but delta itself changes as well. How much delta changes when the underlying price changes is going to be measured by gamma. And this is a very important Greek as well. Even though it's a second order Greek, it's one of the ones that we're going to pay the most attention to. Gamma measures how much the delta changes as the underlying price changes. Delta changes with implied volatility as well, and that's measured by Vanna. Now, we're going to start talking about some of these higher order Greeks that maybe are not going to be available in your brokerage platform. But it's even though we don't have a way to access them, it's important to know how they behave and how they affect the Greeks that we do care about. Okay, so how much delta changes with implied volatility is measured by Vanna. How much delta changes as time passes, it's measured by another Greek called charm. And then we're going to look at gamma itself, which is going to be a second order Greek, how this one changes. So these are going to be third order Greeks. Okay, how much gamma changes as the underlying price changes is going to be called speed. How much gamma changes with implied volatility is going to be called Zomma. And how much gamma changes when time to expiration changes is going to be called color. Now, these ones, they have funny names and everything, and they're good for a laugh and everything. But in reality, we don't need to know how to calculate them and what they measure and everything. It's important to know what they measure, but the most important thing is to know how gamma changes as underlying price changes, as the implied volatility changes, and as time to expiration changes. So the most important thing is to know how they behave so that when we have a position on, we're not surprised by thinking that you have a certain exposure and then having an actual a larger exposure to a certain parameter. So that's why they're not going to be something that we're going to be looking at numerically, but it's important to know the concept of all these Greeks. If we look at Vega, which measures the how much the option price changes with implied volatility, Vega itself also changes. How much Vega changes with the underlying price is called Vanna, and how much Vega changes with the implied volatility is called Vomma. And the how much Vega changes with time to expiration is called Veta. And that, again, the names are funny and everything, and they don't really mean too much to us. It's just important to understand how they move and how they affect us. Theta also changes with the underlying price, and it's called charm, and it also changes with implied volatility. It's called Veta, which is the same one as this one. And it also, theta itself changes with time to expiration. It's called theta. Again, all of these higher order Greeks, with the exception of gamma, are going to be important to us in the sense that we need to understand how they affect our main Greeks, but we're not going to be calculating them, and we're not going to be applying them. If you are ever in a position to manage tens of millions of dollars and your portfolio is like that, then those higher order Greeks are going to be factors you're going to have to pay a little bit more attention to, because now if you think that you're exposed, for example, to implied volatility, and you have a certain number in mind, but then the implied volatility changing also changes some of the other factors, then things might snowball and turn your position into something that's going to be more exposed to the market than you thought you were. So what we're going to do is we're going to take delta, and we're going to see how it changes with underlying price changing, with implied volatility, and with time to expiration. We're going to take these four, delta, Vega, theta, and gamma, and we're going to see visually how they change as underlying price changes, as the implied volatility changes, and as time to expiration changes. We're going to be making an assumption that there is no dividends and that the interest rate, that the risk-free interest rate is zero, just to make the formulas a little bit simpler, because we're going to be touching on some formulas, and it's not necessarily so that you apply them or that you develop them, but it's just to see how those factors affect those Greeks that you use on a daily basis. And for that, you need to I wanted to make the formulas a little bit clearer and simpler, so that you can get down to the basics and apply all the factors that actually have an input into those Greeks. So what we're going to do is we're going to look at several graphs, and they're going to have three lines, and those lines are going to have different color. The line with the green color means higher or more of the parameter that we're analyzing. So if we are looking at delta and we have three lines, the green line is going to be when the price is higher or it's at a higher level. Then the black one is going to be lower than this one, and then the red one is going to be the lowest of them all. So if I look at delta and I have the green line, this is when the price is higher, and then with price lower, it's going to be the black one, and then the red one is going to be with the lowest price of these three that we're analyzing. So you're going to see how that graph changes with price. Same with implied volatility, same with time to expiration. The green one is going to be the one that has the most implied volatility, the black one, the one that's in the middle, and the red one is going to be the one that has very little implied volatility. And you're going to see the graphs and how they change, how their shape changes, and how you can see this evolving over implied volatility, time to expiration, and the underlying price. When we talk about the formulas, also, I'm just going to make a comment here. We're going to be talking about two versions of the standard normal distribution. We're going to be talking about the cumulative standard normal distribution, which is capital N of another variable. And we're going to be talking about the actual standard normal distribution, which is going to be lowercase n of that variable. When you talk about a cumulative standard normal distribution, you're going to talk about a certain point in this axis and then getting the area under the curve. So from minus infinity to that point and what the area is. And this is what this is going to be measuring. This one, the lowercase, is going to measure just the value of the curve at that point, not the cumulative area. So if I talk about lowercase n of d1, I'm going to be measuring this distance only, not the area under the curve. So this is going to be different because for some Greeks, we're going to use the cumulative, and for some other Greeks, we're going to be using just a standard normal distribution. That's going to give you an idea of the shape of the curve that you're going to have for those particular Greeks. And we also know that the at-the-money straddle is going to be 0.8 times the stock price times the implied volatility times the square root of time. And the time is going to be expressed in fraction or a proportion of a year because the implied volatility is expressed on an annualized form. The at-the-money straddle is going to be used in the formulas to give us approximations for those Greeks that we're going to be looking at. And it's now we know how to calculate it, and of course this calculation is assuming that there's no dividends and that the risk-free interest rate is 0, which is perhaps not the most accurate definition of the at-the-money straddle, but it's going to give us a pretty good approximation to the actual value. So we're going to start by looking at delta, and delta is the cumulative standard normal distribution of D1. Remember, these are formulas where I've assumed that we don't have any dividends and also that the risk-free interest rate is 0. So this is just an approximation. The cumulative standard normal distribution of D1 is obtained from the Black-Scholes model, and we've already looked at it. And the formula is not the main thing here. What I want you to see is the visual representation of how delta changes as all the other parameters change. So to start with, how is the distribution of delta with different stock prices? So first of all, if you take remember the green one is the one that's the highest, and then the black one is in the middle, and the red one is the one that's the lowest. So the green one is going to be for stock prices that are really high. So think about a stock price that's trading around $800, for example, Tesla. And the black one would be a stock that's trading somewhere between $100 or in that range. And the red one is going to be a stock that's trading at a very low price. So for the ones that are very expensive, of course, those deltas are going to be more spread out, because every price here is going to represent, if you look at it as a proportion of the at the money price, is going to represent a very small portion. Because of this, those deltas are going to be spread out in a little bit. Those values are going to be spread out very wide. If the price is at a level that's less than the one that's very high, it's going to be something similar to the black line, which is not as spread out as the other ones. And the red one, for very low prices, is going to be a curve that's going to be very sharp and resembling the actual value at expiration, which is for options that are in the money. In this case, we're looking at, for example, a call. For options that are in the money, okay, like these ones they're gonna have a delta of 1 at expiration, and the ones that are out of the money are gonna have a delta of 0. So the price level determines the shape of the curve if we keep these strike prices constant. Okay. Now, how does delta change with implied volatility? Well, if you have a lot of implied volatility, those deltas are going to be more spread out. Why? Because these ones, if you see here, for example, at this strike price, this, or for example here, the ones that are out of the money, at this price, the one that has the most implied volatility has a certain probability of actually getting in the money, so the price going higher. So because of that, because the probability is higher for this one, the delta that's assigned to it, or the delta that's calculated for this one, is going to be higher. And because of this, the overall curve is going to be more spread out. If a certain underlying doesn't have a lot of implied volatility, it's something similar to this, the delta is going to be like this. And if your underlying doesn't have a lot of implied volatility, well, the only ones that are going to change are probably the prices, the strike prices that are very close to the at the money, because there's not a lot of implied volatility. Because of this, the curve here is going to have a very sharp angle, and it's going to again approach the actual value at expiration, which is 1 here and 0 here. Okay, so remember, at this point, we're seeing how changes in implied volatility affect the delta, and we're keeping everything else constant so that we can isolate the effect of implied volatility on delta. Now, how does delta change with time to expiration? Well, delta, as time starts passing, that if you have a lot of time, the graph is going to be like this. The curve is going to be spread out. As time starts passing and there's less and less time to expiration, you're going to see that line is going to start approaching the actual expiration line, which is going to be, like I said, a very sharp line where it's 1 for everything that's in the money and 0 for everything that's out of the money. So when you have very little time, the delta is going to be 1 for most of these strikes, and then 0 for most of these strikes, and only these ones are going to have a certain delta, or a meaningful value of delta, because those are the ones that can actually change. And those are the ones where you still don't know. This is where the uncertainty lies, here in this area. So this is how delta changes with time to expiration. So as you can see, delta, as the price changes, as implied volatility changes, and as time to expiration changes, delta also changes. And these are the Greeks that measure that. Gamma, we already know that, how the delta changes as the price changes. Vanna for implied volatility, and charm for time to expiration. Again, this is just a name. We don't need to calculate it, but we know now. Now you have a visual understanding of how delta changes as time to expiration changes. Finally, if we look at the distribution of delta, we have some formulas that we can use. We've already seen these formulas. The delta for the at-the-money, for an at-the-money call, is going to be equal to 0.5 plus 0.2 times the implied volatility times square root of time. We already see that we've already seen this in a previous lesson, and it's going to be a value that's going to be very close to 0.50, but not exactly 0.50 for a call. Now, as you start to move by one straddle, if you go lower in price by one straddle, by two straddles, the delta can be approximated by using the delta of the at-the-money plus 30 as you move in the money, and by 45 if you move two straddles in the money. If you move one straddle out of the money, then it's going to have your delta that you calculated at the money minus 30. And then if you move by two straddles, you can approximate the delta by having the delta of the at-the-money straddle, or the delta of the at-the-money call in this case, for example, minus 45. Okay, so this is the distribution of delta. If we're not changing anything, if you're just looking at the delta of the at-the-money call, for example, and then you move by one straddle, you can take this delta and add 30 deltas, and you're going to get an approximation for this value of delta. And then if you move by two straddles, you're going to have the same delta of the at-the-money plus 45. If you move out of the money by one straddle, you just subtract 30 deltas. And if you move by two straddles, you subtract 45 deltas. So now we're going to talk about gamma. And gamma is obtained by applying the formula of the standard normal distribution of D1 divided by the stock price, the implied volatility, and the square root of time. As you can see, it's not necessary for you to memorize this formula, but you can see that it's directly proportional to the standard normal distribution and inversely proportional to the stock price, the implied volatility, and not time, but the square root of time. So how gamma changes as the price changes. So for very expensive values of stock price, very high, the gamma is going to be very short and thick in the middle. And as the price starts going down, so for stocks that have a lower price than the ones that we just talked about, the gamma is going to start going higher. So it's going to be taller, but it's going to be thinner in the middle. And it's going to start being zero at strike prices that are closer to the at-the-money. And the extreme example, when the stock price is very low, gamma is going to be very, very high, and it's going to be tall and skinny, tall and very thin in the middle, so that if you're at the money, you have a very high value of gamma. So this is when you analyze gamma and you compare it to the underlying price. Okay, something that's important to notice here is that the total area underneath gamma, so whether we have very high values of the stock price, or medium values of the stock price, or very low values of the stock price, the area is the same. Because of this, you have pretty much the same value here, and you're just stretching it to make it taller and skinnier as the price goes lower. So if you have, one of the interesting things to notice here is that if you have stock that has a very low value, your gamma is going to look like it's very, very high, and you may think that you have a lot of risk there. But in reality, because gamma is measuring price moves, a price, if a stock moves by $1 and the stock price is $3, it's a very high percentage of the price. And this is not measuring percentages. This is measuring moves in the unit of $1. So because of this, you have to be aware of how gamma changes when you compare it to underlying price, because the risk that you might be seeing in your platform might be overstated if the price of the underlying is very low. Now, what happens if you analyze gamma and how it changes when implied volatility changes? So when you have very little implied volatility, it's only the ones that are near the at-the-money that are going to be affected. Remember, gamma measures how delta changes as the the underlying price changes. So the gamma is going to be very high when you don't have a lot of implied volatility, because only these can change and not these ones, because the implied volatility is very little. The delta is pretty much insignificant, and whether it is 0 or 1, it's going to remain very close to 0 or 1. When you start having more implied volatility, the curve is going to start being shorter and thicker in the middle. And when you have a lot of implied volatility, the gamma is spread out so that even these strike prices that have a certain delta have a value of gamma. So they might still change and become more positive or more negative. The ones with very low implied volatility, like the red curve, those are not going to change because the implied volatility is very little. Because of this, if you have a delta of 1, for example, for in-the-money calls, you're not going to have a lot of gamma. So, okay, so the price changes, but because price changes, okay, it's going to affect my delta, but it's not going to affect it very much because the implied volatility is not very high. So because of this, the probability that you're going to, if you're in the money, the probability that you're going to become out of the money is very little. And if you're out of the money, the probability that you become in the money is very little as well. So this is the curve, and notice this is the same shape. We're just going to be analyzing it with implied volatility. Now with time to expiration, this is how gamma explodes, and this is something that you can see now visually what a lot of traders talk about. The options, when they're about to expire, have a very high value of gamma. Why? Because you can see it here. Because when you have a lot of time, the gamma is spread out more, and then as time starts becoming less and less, as expiration approaches, you're going to start having this value here, so that it starts going higher. So it's going to be taller and a little bit skinnier than what you had when you had a lot of time to expiration. And then as it approaches actual expiration, you're going to have this tall and skinny curve here. And what that means is that if you have a position that has negative gamma, for example, if you sell options and you're very close to the at-the-money, you have a lot of gamma. So you might be in the money at some point, and then immediately thereafter, you're going to be out of the money. So the gamma is very high. This is what this is visually showing, that as time to expiration starts decreasing and you start getting closer and closer to expiration, this value is going to start getting thinner and taller. Okay, and if you see here, it's the same basic shape. It's just going to have different values, of course, but the actual shape is what's important to understand. Okay, so having more or less implied volatility is, in terms of gamma, the same as having more or less time to expiration. And if you look at the formula, it makes sense because the stock price is on the denominator, the implied volatility is also on the denominator, and the time to expiration is also on the denominator. So because of this is how this is going to grow as you approach expiration, as you approach a very low value of implied volatility, and as you approach a low value of underlying price. Okay, so these are pretty much the same graph. As price changes, implied volatility changes, and time to expiration changes. Now, if we want to look at the distribution of gamma, by approximating using the value of the straddle, the At-The-Money Straddle, you're going to have this shape, because remember we mentioned is the standard normal distribution. Okay, so the basic shape is that one of the standard normal distribution. Because of this, you have something like this. So there is no direct way. You have to develop the formula. But if you take advantage of the fact that from the at-the-money, 2.5 straddles down and 3.5 straddles on the way up, this curve approaches a line here, you can assume and you can approximate a linear distribution of gammas from in this range from the at the money 2.5 straddles down and 3.5 straddles up. And you can easily calculate the gamma of the at the money straddle as being 64, the number 64 divided by the value of the straddle. So if you have a straddle that's trading for $8, for example, an at the money straddle that's trading for $8, then the gamma for the at the money straddle is going to be 8% or 0.08. Now this one, remember, this is half for the call and half for the put, so that you can do those calculations in your head. Again, this is an approximation. Old school traders on the trading floor, used to apply these formulas quickly, easily. There was no platform, no way to get those numbers. So this is a quick and dirty approximation. And it's good to know, even though everything is on the platforms now and you don't need to mentally or to have this calculation, to do this calculation in your head. It's important just to understand that this is a linear approximation of the value of the value of gamma, and that it peaks right at the money, or very close to at the money if we want to be strict in the formula. Very, very close to at the money is the highest value of gamma, and it starts going down as you go further and further away from the at the money. Next up is Vega, and Vega measures, of course, the value of the option, how the value of the option price changes as implied volatility changes. So Vega, which is represented with this symbol, which is the Greek letter nu, is going to be equal to the standard normal distribution, stock price, the square root of time, and divided by 100. So basically, Vega is proportional to the stock price and to the time remaining, so time to expiration. And this 100 is because we talk about Vega in percentage numbers. So let's take a look at how it changes over price, implied volatility, and time to expiration. So if you have a higher price, you're going to have more Vega. Why? Because the price is going to make higher price is going to make your option itself have a higher price. And because of that, your Vega is going to be proportional also to that. So more price, more Vega, less price, less Vega, until very low stock prices are going to have very little Vega. But the basic shape, again, is the same one as the standard normal distribution, just scaled up or down depending on, in this case, the underlying price. So how does Vega change when implied volatility changes? Now remember, the Vega measures how much the option price changes as the implied volatility changes. Okay, so if implied volatility goes higher, the option price is going to go higher because of Vega. But how about Vega itself? Is it going to push it higher as well? Well, what happens here is a very interesting property. Not every trader is aware of this, but the implied volatility, as implied volatility goes higher, it's going to push those values of Vega for out of the money options higher, but not the at the money. The at the money is constant for all the values of implied volatility. So if you have more or less implied volatility, the at the money value of Vega is going to be roughly constant. But the out of the money values of Vega are going to start going higher if there's more implied volatility. Okay, so don't get confused, because it's very easy to get confused. I myself was confused when I started looking at this many years ago. So when you have a certain value of Vega, okay, at the money, and the implied volatility changes, the option price is going to change. It's going to go higher if implied volatility goes higher. That's understood. That's what Vega measures. But Vega itself is not going to change if you're close to the at the money. If you're out of the money, if you have a certain Vega here and implied volatility goes higher, then yes, your Vegas are going to start going higher. Okay? So this is a very special way, or a very special a distribution of the values of Vega with respect to implied volatility. At the money, it doesn't change, but out of the money, it moves with the value of implied volatility. More implied volatility, higher Vega. And depending on where your strike price is, it's going to be where how much your Vegas are going to be affected by implied volatility being higher. So as they go higher, it lifts up the values of the Vegas, but only for out of the money. And finally, with time to expiration, when you have a long time to expiration, you have a lot of Vega, and it starts going down as the time starts decreasing, as you start approaching expiration, so such that when there's barely any time to expiration left, you have very little Vega. And this is proportional, and this is very easy to understand. Something similar to the price, okay? More time to expiration, higher Vega. That's why when you have a calendar, for example, you sell the front and you buy the back. The reason you buy the back is because it's going to have a higher Vega. And this is the graph that's showing you how that distribution of Vegas is based on time to expiration. Now, something similar to what we did with the gamma, the Vega is going to have a basic shape of the normal distribution, but from the range from at the money 2.5 straddles down and 3.5 straddles up, we can approximate a linear distribution of Vegas, and we can calculate the Vega of the at-the-money straddle as being the value of a straddle divided by the implied volatility. So for example, if the value of a straddle is 16 and your implied volatility is 16%, then your Vega is going to be 1 for the whole straddle. Remember, half of it is going to be for the call, and half of it is going to be for the put. Okay, so it's very simple. Basically, the value of a straddle scales up or down with the value of implied volatility, and when you calculate the Vega, you just divide by the implied volatility. Now, this is true only at the money, because remember, the natural logarithm of the stock price divided by the strike price is going to be 0. So that makes the calculations a little bit more straightforward. So at the money, based on the at-the-money straddle, the Vega of the at-the-money straddle is going to be the straddle divided by the implied volatility itself. And now theta. Theta is going to be a negative value when you're long an option, call or put. Okay, so that's why I've included the sign here, the negative sign, so that the graphs themselves are displayed in a similar way like the other ones that we already saw. But remember that this is a negative value when you're long calls or puts. Theta is going to be the standard normal distribution of D1 multiplied by the stock price multiplied by the implied volatility divided by 2 times the square root of time multiplied by 365, so that you can get the value per day. Okay, you can easily see here that the basic shape is going to be that of the normal distribution. It's going to be directly proportional to the stock price, directly proportional to the implied volatility, and inversely proportional to time. Okay, so here we have the negative of theta. So this graph should go on the bottom, but just so that we can understand a little bit better, I've decided to graph the negative of the theta. Okay, so we have how theta changes with the price. So if you have a higher price of the stock, the theta is going to be higher, of course, because it's the price itself is higher. So remember, theta measures how much money are you going to lose if you're holding a call or a put and time passes. And this is how theta is distributed as the underlying price changes. So for very expensive underlyings, theta is going to be higher. For not so expensive, it's going to be less. And for very cheap underlyings, the actual numeric value, so the absolute value of theta, is going to be very small because it's proportional to the actual value of the option, to the actual premium price. With implied volatility, higher implied volatility is going to result in a higher premium of the option, which is going to mean that more money has to come out of that premium based on theta. And because of this, it's a very similar graph as the one we had. When there is very high implied volatility, premium is going to be higher, so theta is going to be higher. When there's less, then theta is going to be less. And when there's barely any implied volatility, theta is going to be at its lowest. Okay, it's proportional to implied volatility, proportional to the price level. And how does theta change when time to expiration changes? And that, as you can see, is something that's very similar to how gamma behaves. So as time starts getting closer and closer to expiration, so the red, this is going to be the highest point right at the at-the-money. The out-of-the-money are not going to have a lot of theta, but the at-the-money is going to have the maximum value of theta, and it's going to be very close to expiration. On expiration day, theta is really a very, very high value. Okay, so this is what traders tell you when they say that you have to hold your options to expiration, because theta, especially at the money, is going to be very, very high. Now, if you're out of the money and you remain out of the money and time passes, then you can see that at the beginning you have a lot of theta, and then actually you start getting a little bit less theta and less theta. Okay? Because remember, this is a similar shape to what you had in gamma. So the total area under the curve is going to be the same. So you're just taking this value and stretching it up. Okay? So because of this, if you have out of the money, so this is something very important to understand. If you have out of the money options and you want to see how they decay, and maybe your profits depend on time decay, if you're selling options, for example, then if you have them at the money, you have to wait almost until the end to really get a lot of theta. If you are actually out of the money, then what's going to happen is the value here, even though it's going to start actually going lower, it's going to be very constant. So that's why it's said that out of the money theta is very constant. And actually, if you're close to the at the money, it makes sense to not wait until the end, because if you're in this area, then you're not gonna have a lot of theta here. So when you're at the money, you have to wait until the end. When you're out of the money, your time decay is going to be a little bit more constant, and actually might even decrease as you start approaching expiration. Theta is something similar to Vega and Gamma in that it has the basic shape of the normal distribution, and again, we can approximate a linear distribution of theta in a range from the at-the-money 2.5 straddles down and 3.5 straddles up. Why is it 3.5 here and 2.5 here? Because we're talking about a log normal distribution. So on the way to zero, you have a finite range that you can go down by, because it's bound by zero. And on the upside, there is no limit. Because of that, the distribution is log normal, so it's not precisely symmetrical. Even though, for ease of understanding, I've included a symmetrical shape here. In reality, it's not symmetrical. It's a little bit pushed to the right, because on the upside there is no limit. So that's why in this case the it would be log normal, and because of that, the range is 3.5 on the way up and 2.5 on the way down. So the at-the-money straddle, again, we can calculate the theta of the at-the-money straddle. Remember, the at-the-money straddle has a the strike price that's right at the money, and it's a short or a long call and put. Okay, so it's going to be equal to the value of the straddle divided by 2 times the number of days, and this approximation is going to be valid up until maybe 2 or 3 days before expiration. Any time after that, it's better if you actually calculate the theta using Black-Scholes or using your platform, because then because of this explosion in value, it's not going to be very close now to the approximation. The rest of the time, so if you have a 45-day position, for example, you can calculate the theta of the straddle, and by getting the theta of the straddle, you're going to be able to get the theta for the call and the theta for the put, and the theta for the call and the theta for the put are going to start declining in this approximation linearly, and you're going to be able to calculate the theta for any strike price in this area. Again, once we get very close, like 2 days before expiration, these values are going to deviate from the actual values that you can get by applying Black-Scholes, the ones that are in the market. But anytime prior to that, you can get a quick estimate of the value of the theta based on the of the at-the-money straddle, based on the value of the straddle. Okay. So now that you've seen the how the all the different main Greeks change as underlying price changes, as implied volatility changes, and as time to expiration changes, we can put them all together in a single graph, in a single table, and you can get a good visual understanding and a good visual image of how they are distributed. The delta, as the stock price changes, gamma, vega, theta, this is what we've seen, and this is what we saw in this lesson, but just in a single table, so that you can have everything at a single glance. Now, I'm going to be uploading this table to my website, which is optionsinplainenglish.com, single word. So optionsinplainenglish.com, and you can go there, and I'm going to have this on one of the sections about documentation or something like that. I'm going to put it up there so that you can download it if you would like to do so, and you have the how these Greeks move based on stock price volatility and time to expiration, and also an approximation for the distribution, and especially for the based on the at-the-money straddle. And you'll be able to understand more or less how all those Greeks work together and how they interact with each other. I hope this information, there was a lot of information, and most of it, you're not going to be probably using the formulas or anything like that, but you are going to understand how those Greeks move in time, in volatility, in stock price, so that you know that as you have your positions and as time starts passing and as you become out of the money, in the money, you stay at the money, for example, you're going to have a good understanding of how your Greeks are going to move, and you're going to have a good feel for how your position is going to be affected as all these parameters start changing. Thank you very much for your attention, and goodbye.